Then on Friday, MBS were down 28 basis points real early. Stocks continued their run by being up 12 points. The overnight session was actually fairly calm and contained for bonds. Volume and volatility picked up right at the 8:20 CME open when many bond traders begin their trading day. Some of the weakness is just because, unrelated to obvious reasons, individual catalysts. Some of our weakness seemed to be coinciding with the hawkish Fed comments. We had Waller that was out saying core inflation is not moving, may need more tightening, not coming down like he thought it would. Barkin said if the Fed backs off too soon, it risks having to hike more. He also said I'm comfortable doing more if data warrants it. Slowing pace of rate hikes gives time to assess data. Waller also said that the U.S. economy is still ripping along. Still not clear, recent bank failures had a material effect on credit conditions. Monetary policy should not be altered due to ineffectual management at a few banks, which I kind of agree with. We're seeing a situation now where the Fed is signaling at least 2 more rate hikes, but markets are stuck in the idea of just one. At this week's meeting, 12 of the 18 Fed members projected the Fed funds rate would be 5.5 at the end of the year, but markets are still pricing in a high of 5.25, basically the same pricing as one more hike in July. Consumer sentiment came in at 63.9 on a 60 forecast was 59.2 previously. The 1-year and 5-year inflation estimates came in lower than previously. Don't know why they think that. Whatever. New lease asking rent growth is plummeting after a rising 14.5% year over year through last May. New lease rent increases rose by 2% in 523 compared to 522 and may well turn negative, something that since the housing bust only happened during the first few months of COVID in 2020. The new lease rents barely rising. Renewal rate increases are also softening because rental vacancy rates have risen by a substantial 2 percentage points year over year. Bonds might have had a chance to hold steady today, and to be fair, they did hold steady in the bigger picture, but some combination of Fed speakers and position squaring resulted in a morning sell-off. The afternoon was a dud with no major movement because pretty much everybody was quitting for the day probably. Next week brings several Fed speakers that may help us figure out if views expressed on Friday are widespread. At the end of the day, we're down 16 basis points, which puts the MBS at 100.08, which puts us in this range bounded by the 25-day moving average, which is the descending red line on the floor, and a ceiling at 100.342, which gives about a quarter run up. So I also got an article from Yahoo Finance that breaks down the population of homeowners and where they sit in their current mortgage rates. The housing market's tight inventory doesn't look like it'll be getting any better anytime soon, with 91.8% of borrowers have rates below 6%. The high was about 92.9% in 2022, and 82% are below 5%. At the bottom, locked in at super low rates, 62% have rates below 4. So there's not a big incentive to move because higher prices on houses, higher rates means giant payment changes. Looking at next week, we are closed on Monday for Juneteenth. Then on Tuesday, we get the first of the Fed speakers. So Bullard is going to be speaking. We also get housing starts and building permits. On Wednesday, we get some more Fed speakers and a 20-year bond auction. On Thursday, jobless claims, which has been carrying more and more weight, as well as Fed Chair Powell testimony. And Meester is speaking, as well as a 5-year note. And then Bullard speaking again next Friday. Boy, these guys like to talk. And also Meester speaking. So with all of this stuff and people trying to predict the market, these Fed speakers are going to carry a lot more weight going forward. So if you have some time over the weekend, check out our common sources and influences at www.wellthatmakessense.com. Got a great series going from information from Alex Hormozy, which will definitely help you be happier and make more money.